Welcome everybody to today's tutorial analyzing a multifamily product. To begin with, you would go to thepropertyledger.com, input your username and password. To the extent that you don't have one, we encourage you to go sign up for the free 30-day trial. Once you have your subscription and once you enter in, you will come to the financial dashboard, which is really the nerve center of the property ledger. The dashboard provides an indication as to what the equity in your real estate portfolio will be upon the payoff of your last mortgage of the property you hold in your portfolio, as well as what your net monthly cash flow will be once that last mortgage is paid off. So these are very important numbers to you and really provide your why as to why you're investing in real estate. So let's jump into today's topic, and because we are analyzing a new rental property, we'll want to click on the icon that takes us to the first step in inputting a property into the property ledger. As you see on the top header of the page, we have a number of different steps ranging from step 1 to step 8, and the green box will indicate to you where you are in the input process. So let's begin. Let's assume that we are inputting a duplex unit, and we'll call this duplex 1, 2, 3. We would click on this. We would go down here, click on the type of property it is. Obviously it's a duplex, so we have 2 units. Let's assume these are 900 square feet each. So we have a total of 1,800 square feet. To the extent we wanted to include this in our portfolio, we would click on this, but because we are just analyzing this for a potential acquisition, we'll hold off on adding it to our portfolio summary until we're sure we're going to do that. The address is 123 Street, and let's assume this is in Phoenix, and it's in the state of Arizona. Obviously we're in the United States, and our postal code is 85018. Once we're done, we merely hit the button on the lower left-hand corner of the page, and it'll take us to our step 2, which is inputting our property costs. Let's assume that we are purchasing the property, and let's assume that we're going to purchase it on the 3rd of January 2012, and let's assume we're paying $100,000 for this duplex, or $50,000 per unit. And the property ledger allows us to, should we be buying a property for less than its fair market value, we can also input what its current fair market value is, and our appreciation rates will be generated based upon the fair market value as opposed to a purchase price. So let's assume that the fair market value of our duplex is really $110,000. From there, we can go and take a look at should we have any 5-year personal property that we want to depreciate over 5 years, or 7-year personal property. This allows us to get into cost segregation. If you're not familiar with cost segregation, we'll be getting into this in our financial tutorial series, but suffice it to say that if we take our rental property apart and break it into various segments, meaning appliances, HVAC, plumbing, etc., we can depreciate those items over a shorter term than we can the actual structure, which is 27.5 years, because this is a residential property. For commercial properties it's 39 years. But let's just leave those blank for right now. Also, when we're determining our depreciation, we can't depreciate land, so therefore we have to make an allocation of our purchase price to land. In this instance, we're going to assume that 20% of our purchase price, or in this case $20,000, is allocated to the land, which is, as a general rule of thumb, a pretty good assumption. Now we go down to our default annual property appreciation rate. This is the rate at which our property will be appreciating over time. And let's just assume that we are going to appreciate at 3% per year unless we tell the program to use a different rate, which we do have the ability to do with the property ledger through the use of our variable property appreciation rates. We'll get to that in a minute. We want to input our net present value discount rate, which is, in a nutshell, and the simplest way to think of this is the minimum return that we are willing to accept as it relates to our investment. This discount rate will be utilized to calculate our net present value of our cash flows, and to the extent you're not familiar with net present value and discount rates, etc., here again we encourage you to go take a listen to our tutorials in relation to financial terms and concepts. But let's input 15%. Future selling expenses, if and when we sell this property, we're going to have to pay commissions, closing costs, proration of taxes. Let's just estimate that at 7%. And if we want to, we can input a property sales date, but we're going to hold this for the long term. And one of the other things is we can base our future sales price on appreciation rates, cap rates, or gross rent multipliers. But for purposes of our analysis here today, let's just use the appreciation rate. But I just want you to understand that you can determine future sales prices through a number of different ways using the property ledger. Once all of our information is input, we have the ability to save and enter variable appreciation rates, save and add closing costs, or save and continue to future improvements. And let's go in and let's assume that we need to input some variable appreciation rates. So we click on that, hit next, and the property ledger allows you to use variable appreciation rates over time. And because the market really isn't that great in Phoenix, let's assume that for 2012 we are not going to see any appreciation at all for our unit. So we would input that. The program will assume that there will be no appreciation in 2012. If it's not told to use a specific appreciation rate, the property ledger will use our default rate. So let's save that and let's go add another one for 2013, and let's assume for 2013 that we have a 2% rate. And at this point, let us save that, and we'll go to our future improvements. So let's go. You can see we're at step 3 right now. This is where, to the extent that we need to do any improvements to our acquisition, we have the ability to do that, and then also determine if those improvements are going to have any, if they're going to increase the value. But let's assume that we have to do some general remodeling of the unit, and that's going to cost $2,000. We're going to make that literally after we close on the property, but let's assume we expend those funds on the 16th of January, and let's assume that they increase the property's value by, say, 50%. Now we will click out of that, and we're going to continue to our financing. Step 4 is our financing. We have the ability to add a single mortgage, or we have the ability to utilize the 2 mortgages, a primary and a secondary. For our purposes here today, let's assume a single mortgage. Our down payment, we can enter either an amount, a dollar amount, or we can input a percentage. Let's assume that we're putting 20% down, that we have a 4.5% interest rate on that, and here we have the ability to pay interest only. We're going to assume that this is going to amortize over a 30-year period. So let us go down, and our start date would be our acquisition date. We input 360 months. To the extent we want to make other monthly payments to pay down our mortgage quicker, we could input that. We also have the ability to input a percentage for a loan origination. Let's assume we pay a broker 2 points, and we want to add these loan origination costs to our loan balance. Now let's move to the income tax portion of this. Now, one of the benefits of investing in real estate are the tax benefits that the federal government and state governments provide. So it's important that as we're doing our analysis, we take this into consideration. So in this section, we're inputting our income tax information. So here we would input our federal marginal income tax rate. And if you're not familiar with that, you could look at your tax return or look at your income and go to the irs.gov website and determine what that is. But for our purposes, let's assume 35%. Our capital gains rate is 15% presently. And let's assume for Arizona we're paying an 8% tax rate. We would input our depreciation period here. Because we're looking at a residential unit, that being a duplex, the depreciation period is 27.5 years. If we were looking at a commercial property, that would be 39. Now we have the ability to indicate and tell the property ledger if our losses are going to be limited by the passive loss rules. Now, if you're not familiar with the passive loss rules and a qualified real estate professional, I encourage you to go and look at the regs or talk to your wealth team member, or your CPA in regards to this matter. But suffice it to say that we're real estate professionals and our losses are not limited by the passive loss rules, so we are not going to check this. And because we're not planning on a 1031 exchange, because we're not planning on selling the property, we're going to not click the like-kind exchange on disposition, and we will go to our rental income. The rental income, step 6, is our ability to input the rental income. We have the ability to do this as one lump sum, or we have the ability to put it in as a rent roll. So for our initial box here, we're going to be using a rent roll, so we're going to leave that blank, but we're going to drop down to the default average vacancy rate, and let's assume that our vacancy rate on average will be 5%, and then our rent will be growing at 1% per year. Now, here is where we have the ability to do a number of different things. We could add other income. And let's say that we have laundry on hand, so we're going to save and go to that. And we're just going to put in here laundry. And let's assume that we're going to be making an additional $25 a month on that. And that's going to increase at 1% over time. And from here we can add another income or add a one-time revenue occurrence, should that be important to us. We can type in an actual income, and you may want to go in and take a look at the video related to inputting actual operating results. But here is where we're gonna click on save, and then we're gonna enter our rent roll. So we go to click on that, and now we have the ability to input our rent roll. So we have a duplex, we have 2 units, and we're going to go, and you can see that the property ledger sets up 2 units. We have unit A, and we have unit B. Unit A's rent is $750 per month, and unit B, which is a little larger, is $800. So at that point, you can see we've input our rent roll, and let's move on to the operating expenses after we save this and continue on to the expense input. Now we're on step 7, which are the operating expenses. You can see that the property ledger lays out a quite extensive menu of various types of operating expenses that you may want to consider as part of your analysis. But let's just go show you how easy it is to input the expenses. Here we're assuming that we're going to have a CPA prepare our tax return at $250 a month. We're going to have cleaning expenses as tenants move in and out of the unit, and let's say that's $300 a month, or $300 a year, excuse me. We're not in an HOA, so we don't have any of those fees. but we do have property insurance. So let's assume that that is $950 annually. We're going to have maintenance of $200 per unit, in which case that'll be $400. Now, one of the things I'd like to point out is you can see as we're inputting the various figures related to our expense estimates, you'll see that the amount shows up here, and we're also getting the percentage of the expenses as well as the cost per square foot. Let's continue to go down and input our property taxes. Here, let's assume that they're $1,200 annually, and let's assume we do have some common area electrical charges of $250 annually, and we also pay for the trash removal, and let's assume that's $250. So upon the conclusion of all of our inputs, you will see that we've got estimated expenses of $3,600. We now go to the last step, which is to view our summary. One of the things that I always like to do is to click on Build the Summary, because that will go in and recalculate everything for us. But you can see here, now we have input our unit information. It's broken out with the rental income, other income. You can see it growing over time. We have our vacancy and credit allowance. We have our operating expenses. We're backing out our mortgage payments. You can see our capital improvements that we expended in the first year. So you can see our net cash flow from operations. The second series of analyses shows our property sales. So in year one, you'll see that we're basing our analysis off of the fair market value of that property, which was 110. Our projected improvements, we expended $2,000, but they added $1,000 worth of value. We back out our selling expenses to see the adjusted sales price, less our mortgage payoff, plus our tax burden, and you can see our net cash flow from sales if we were to sell the unit in 2012. If we were to sell the unit in 2013, our cash flow from the sale would be $23,121. Our cash position is nothing more than our cash from operations plus our cash generated from the sale less our original investment. So you can see if we were to sell it in the first year, we would be positive $33,185. And then from there we get into our financial analysis, which includes the debt service, the loan to value, cap rates, gross rent multipliers, our present value calculation at 15%, our return on equity, cash on cash returns based on our investment, both before and after taxes, as well as our internal rate of return. Up at the top of the property ledger property summary, you can see that we have our basic information, our duplex 123, which is the name of our property, where it's located, our purchase price, as well as information related to what the property will be worth once its mortgage is paid off in 2042. Our net equity will be $192,000, and this will be generating a $990 per month positive cash flow to us in our retirement. We have other types of icons on the top page. For instance, if we were interested in looking at our tax analysis related to this property, we could do that here. And this really gets into how our taxes were calculated. If we go back to the property summary, we also have the ability to print out many different reports through our report writer. We have the ability to create our summary report, our tax analyst report. We also have the ability to create an amortization report, and let's just show you what that looks like. So we get everything laid out for us here. so that we can help with our taxes. We can also compare that with what the bank is telling us. And then last, we have various graphs that we can generate. And let's look at our equity over time and see what that graph looks like, shall we? Here you can kind of see, this is when we purchased the property, this is when the mortgage is paid off, and then we continually run this thing up. This thing goes out, in this case, for 2070, but you can see the compounding effect of owning real estate over the long term. We hope that this has been beneficial for you, and that you can see how easy it is to input property and to do your analysis utilizing the property ledger. Thank you very much.